Well, good morning again. All right, so far we talked about the basics of securities. We talked about why to invest. That was the second video. So in the first video, I mentioned the fact that we're talking about publicly traded companies. Now, you can invest in private companies, but that usually means you've got a lot of money. I mean, a lot of money. And these private individuals will come to you and say, hey, like I'm going to start a restaurant and I need to raise $10 million. Would you like to be one of 10 people to invest in my restaurant? That would be a private investment. Different laws, different things that govern that, and not really available to the average person. So I had used the expression a publicly traded corporation. So what does that mean? You can have a corporation. And what is a corporation? A corporation is a legal entity. Like, for example, I owned J Kite LLC. It's a limited liability corporation. It's a legal entity. J Kite LLC is kind of like another person sitting right here next to me. It's an entity. That entity can open a bank account. It can do business. Has to follow the laws like a person. All these kinds of neat things. Am I publicly traded? No. There's a lot that you have to go through, things that you have to have in place. It's a big deal when a company goes public, as they call it, and that's usually started with an IPO, an initial public offering. So you kind of see where this terminology ties together. So say I built up J Kite LLC to some big deal, and actually I'd have to be just come J Kite Incorporated, and then I could, through a bunch of process, eventually go public if I thought the corporation was of value, and then I could offer a public offering. I'm trying to raise money, so I sell shares of my company, not all of it, but shares of it, in exchange for getting all this money in. Okay, so if you're going to start off investing, the first thing after people get everything set up, and we'll talk about that in the next video, is well, what do I invest in? What company? Well, there's a lot of different things that you can invest in. For example, you might work in a certain area. Say, for example, you work in the restaurant business. And say you work, I don't know, say Chick-fil-A, I don't know, I'm just naming a company. And you look around as you're working, you think, wow, these people really have their act together. They really are doing a good job, and I want to be part owner of that. You can go and look online, you search Chick-fil-A, and you can look to see if they're traded on the stock exchange. If they are, they'll have a code on their website. They'll give you a code, usually 3 or 4 letters. And those letters, if you type that in, you can see their information that they put out there. Now, if you're when a company goes public and they're selling shares of their stock, they have to report this information out periodically. And all this kind of information is tracked. Okay, why is it tracked? Well, as an investor, you might want to know, well, how much does the stock cost? So you can go and you can see what the current value is. And if the market's open, uh, which it's not open 24/7, but when the market's open during a weekday and during a trading day, you can watch the value go up and down, up and down, up and down. It moves around pretty much throughout the course of the day. And so that's one way to invest. Um, Back when I first started looking into stocks, there's a method or a technique called fundamentals. And what does that mean? That means that you research a company and you're looking at their track record. You're looking back at the last, say, 5 years, 5 to 10 years of their business, and you're looking to see, how did they perform? And there's a lot of different indicators and things that you look at, and then, for example, when I was learning about it in a class I took at a college. The person was following along with what's called the I think it was Investment Clubs of America or something like that. And they had like a spreadsheet, and you'd go through and you'd go get the value line sheet at the library. This is the days when you'd have to go down there to get information, and you'd look up the sheet on that company, and they'd have all this information, and you'd plug all these numbers and things into this spreadsheet. And at the end, what you were trying to figure out is, was it a company worth investing in? And also, it would, based on the numbers that you looked at, you would determine if this is a company, not only one that you want to invest in, but is now a good time to invest in it. And long story short, it was kind of cool. Actually, the guy that taught the class said first time he started getting into investments, he saved up like $10,000. So he went to a broker, right? So he wasn't going to pick the stock himself. He was going to pay somebody at a brokerage to help him invest his money. And he, as he joked around, he said, he goes, I found out why they call them brokers, because about 2 months later, he goes, I was a lot broker. The guy basically lost all his money. So he kind of learned from his lesson, and so he saved up another 10 grand, and he started looking around, and he found this Investment Clubs of America, and he didn't really want to join the club, but he followed their process, and he learned how to use it, and he built himself up to a situation where he had about $1 million worth of stock. His wife got ill, the insurance company didn't pay the medical bills, he did, and it took him back to ground zero again. So he turned around and he did it again. And his little motto back then was, if I can do it twice, you can do it once. Now, the key to fundamentals was trying to study and analyze the management of the company. And the thought process was, a good company with good management, even if they have a bad product, the management will figure out how to fix it and move on and do better. You can have a company with a great product, but if they have bad management, they're going to fail, because bad management will always kill a company. Now, some people still do this. I don't think it's as valid today as it was then, and there's reasons behind that. A lot more than I have time to get into right now. So again, that was called fundamentals. Now, and if you go down that path, and it's perfectly fine, but the idea of fundamentals is typically you're buying and you're holding, and then it's almost kind of like a mutual fund. You're going to ride the wave up and down, up and down. Now, this guy's technique was he liked to buy like 1,000 shares of a company, or pick a number, say 500, and he would hold on to that stock until it either doubled in value, or through a thing called splits. Sometimes the stock will split. A company wants to keep the stock in a certain price range so that investors will buy it. And if it becomes worth too much per share, they will split it, but then cut the value of it in half. So say if you had 500 shares and they're worth $10 each, if they split it, you now have 1,000 shares worth $5 each. So the value is the same, just a lot more stock. But the key is then, if the company continues to do well, your money's going to multiply quicker. His technique was to sit on it until either the value doubled or he had twice as much of the stock. Once he had that, he would sell off that half. And he looked at it as the other half was like free ownership in that company. And then he would just sit on it. And he said, over the years it splits and it goes up in value and down, up and down, up and down, it splits and all this stuff. He says, before you know it, you own, 100, or not 100, but say next thing you know, you own 1,000 shares or 4,000 shares or 10,000 shares. And pretty soon he goes, you own a pretty large chunk of a company. That was one of his techniques. Okay. The other way that you can do this is through technical trading. And that's a lot of what we're going to talk about during these other videos. The technical trading means you simply look at the charts and you look at the numbers that are being presented to you, and you make an investment based off of the charting, and it'll make sense when we start going through it. Um, so why are you doing it? You're looking to, instead of riding that wave up and down and up and down when you're doing technical trading, if you're buying long, as they call it, meaning you expect the stock to go up, you're looking to buy it low, and when it goes up high, you sell it, you take your profits. If you're shorting a stock, you would buy it when it's high with the anticipation that it's going low, and we'll talk about that in a future video. And you can make money when a stock goes down. It sounds weird, but it is what it is, and I'll explain it later. But anyhow, but that's technical trading. And why do you do that? Well, depending on how well you do, you can make more money faster, and you don't ride that emotional wave up and down, up and down. So there you go. Well, enough for now, and we'll see you on the next video. Take care. Bye.